Okay, let's do 21 to 25. This question is on financial assets and financial liabilities. So let's kick off. Which of the following is not a financial asset? So really, a financial asset means you have a contract. These financial assets are about contracts. You have a contract to receive or to, if you like, give. And cash is, if you like, a financial asset. It's cash. Naturally, trade receivable, you have a clear contract there that you will be receiving something in the future. Equity investment, you have the right to receive some value. And prepayment, that's you're prepaid for insurance. So in of itself, that's not like a contract that you can dispose of. You've just paid insurance early. It's not even under the realms of financial assets, right? We're really talking about just a prepayment, really. It's not a contract. And these are all technically the right to receive. The fact that you have cash gives you the right. It's money, so you can exchange it for goods. And in the true sense of the word, it is the right to receive. It's just not visible as we know it in modern times, but it is the right to receive gold in some regard. I like this question because it forces us to come back again to look at what happens with convertibles. In the last mock I mentioned it again, this question of when we see this, the question here is that assets and liabilities should be recognized at their present value. I mean, that is what they are. When you see an asset or liability, it is being recognized at its present value of its future income streams or future liabilities. And therefore, when you see, because we amortize liabilities, when you put an amount and say, oh, I owe someone this, what you're saying is it will accrue interest over a period of time and I will pay a certain amount at the end. And so therefore, this is the present value of this. Now, nothing more, nothing less should be in there. That is the present value of this loan. That's just what it is. So, because that's the relationship, that's the relationship of the contract. So when we look here, we have this agreement where you've received 4 million in the bank, and you have said, I will pay every year 3% on this coupon rate. You've said you're going to pay 3% of 4 million is 0.12. So you said you'll pay 120,000. So you said you're going to pay 0.12 at the end of every year. So that's the 31st of December, x6, 0.12, x7, 0.12, x8, and 0.12, x9, as well as the 4 million that you owe. That's what you've said you're going to pay. So technically, this should be equal to, if this was a fair transaction, otherwise we wouldn't have it. Otherwise, someone will be making a profit straight away. You've said you're going to pay all these amounts, if you like, in the future, and this should be technically equal to the 4 million, but it isn't, because you have also agreed on receiving this money that you will pay these amounts, but you will also give some equity. The question is, what is that equity value? And that's what we're trying to find out. So what we need to do is to find the present value of these amounts. Remember, this is the coupon rate. It's literally sitting next to the word convertible loan at par. What we now need to use to find that is the market rate of a similar loan. So just treat it like a normal loan. Remember, the standard doesn't recognize convertible. It just recognizes a loan and equity. That's what it does. And so splitting that up, they've done that already here. So don't fall for that. Highlighted that before. That's the coupon rate. Don't fall for that. I'll say it again. Don't fall for that. Right. And so you have 6%. That's the market rate. They've done it for us already. So I just need to multiply those figures respectively by those amounts. Multiply those figures. And I've done that. And I have here 0.1128. And I have here 0.1068, and I have here 0.1008, and I have here 3.2548. And when you add all these packets together, you get a total figure of 3.5752. So you need to recognize a liability account of 3.5752, because when I start accruing and amortizing in this relationship where I'm paying off, I'll accrue interest at 6%, I'll pay off 0.12, carry down, accrue interest, pay off 0.12, and you keep on going. You will arrive, if you like, at this final payment that you should make. That's just the relationship here that we observe. Therefore, it means that the balance must be equity. So that's the liability. And the balance, therefore, when you subtract those two things, 4 and this must be 0.4248. So there you are, 0.4248. That's your equity element there. Okay, great. How's the liability element of convertible loan to be? So if we are keeping the loan to the end, and we are, so the key point is if you are accruing interest and paying off some principal, accruing interest and paying off principal, we refer to that as the amortized method, amortized cost. You're doing it over a period of time. Think of it like a kind of like a depreciation, but a similar principle in theory of doing things regularly over the year. Let's look at this next transaction. So Cobb. So basically, what have you done here? You have Cobb here. Barely, it says 2% shareholding. It's nothing. It's a financial asset. Straight, just selling. It tells you even anyway that you're doing it for trading purposes. You'd have hit yourself with transaction fees. It's just, this is just an expense as normal. When you bought these goods, sorry, yeah, I could almost call them goods. When you bought these shares, debit transaction fees, credit bank. It has its own code, if you like. And at the end of the year, the shares have gone up in value. So this has its own separate code under transaction fees, just like any normal transaction you would have here. Shares were £4.50. So because you're all holding such a small amount, and it says the plan is for trade, so fair value through profit and loss. If it's for trade, you're happy with the volatility. Movements are going straight to the profit and loss account. That's the whole point. It's such a small amount of shares anyway. So definitely it's increased by 50p. So 50p on each share. So 50p on 100,000 shares is straight 50,000. And all of that goes straight to your income statement, your profit and loss account straight away. 50,000 gain right away. Now, this idea of an irrevocable election. Now, we discussed this. Of course, I know it's been a while, but the point is, when you make this kind of election, you see, because you have such a small holding of shares, it is almost assumed that you intend to sell them. But if you're saying you want to hold shares for the long term, you have to make an election. You have to say, listen, I'm signing a piece of paper that says I want to hold these shares for the long term, and I can't change that. You're going to hold them for the long term. Probably, like I've highlighted several times, maybe in a small company, which means that any shifts, any movements will go to your other comprehensive income. You're sort of saying, I want to shield myself from the shock of volatility and movements in the income statement. I don't intend on selling them. So once you have that, you can capitalize the costs involved because you're holding it for the long term. And then, if you like, just deal with that. So because of that, you can capitalize that, and therefore the full cost of this will be 90,000 times 7, which is 630,000, and we can add on the transaction costs of 20,000, if you like, that we've spent on it, giving it a full cost of 650,000. So because it's almost feeling like a long-term asset, we can capitalize all those transaction costs. So the answer here is 650,000. Cool, great stuff.